gold, silver. You're talking about not treasuries, but treasuries are rallying, yields are falling. You're talking about equities rising. You're talking about gold higher, silver higher, copper higher, crude oil higher, all of these things higher. And Powell is still saying things in the press conference. We're aware of risk that we would hang on too long. Well, I don't know what that means. I don't want to turn this on in the background. Jerome Powell always says things that you don't understand. And the key to this, and again, I'm going to talk to Phil Streible about this in a minute, but the key to this is watching what he says and then watching what the Fed speakers say after this. Right now, they've put 75 basis points of rate cuts into the dot plots. And we're going to ask Phil if that stuff matters or not. So why don't we get to it? Phil, I hate that Jimmy's head is higher than me in that intro. I start every show complaining about that. Did you see that?
I did. I didn't want to say anything though. I think he towers over all of us.
Well, I'm going to point out that you're taller than me and I'm taller than him. Well, he's not here to lie about the fact that I'm clearly an inch and a half taller than him and you're 2-3 inches taller than me. So I think it should go by height. Even if we go alphabetical, I should be above him.
But that very true. Very true.
I had no say in that shit at all. Phil Streible, Blue Line Futures. I've been touting you as one of the best metals guys out there, but I kind of do you a disservice when I do that because you're sort of a macro in terms of asset classes as well, right? Am I wrong in saying that?
Yeah, I mean, all this stuff it all comes together when you start looking at even whether it's like, agricultural markets and things like that. They're all impacted by the macro picture, by the dollar, by interest rates, by, fiscal and monetary policy. And then, yes, weather and things like that do play a role, but it's really the trade balance and things. And it's just the way the way the machine works. So, whether you're looking at one commodity or another, I think that it really comes down to, the nuts and bolts on how the economy works.
It's funny when we decided to do this show at this particular time. I think we're going to start a little bit later next year, maybe by 15 minutes. But it's not all that often that the Fed meeting falls on exactly the time that we're doing the show. So we saw the announcement. We saw the slight change in the statement. We saw that. We saw the dot plots, which we can make fun of or we can compliment, whichever way you want to do. But you see Jerome Powell again kind of talking against what the dot plot said. He keeps trying to say that. One of the headlines I saw while I was waiting for the show to start was, no one is claiming victory. How do you say that? I mean, do you think that it's just the kind of thing he's setting up the market for and doesn't want to admit it?
I couldn't believe that he said that. And then the other thing is that, he's kind of going against everything that he's been saying, everything he's been building up to. He's been very resilient with this like higher for longer type theme. Everyone was expecting, that we're going to see this hard landing, that he's not going to budge on rates. I was kind of shocked when my phone said Fed signals 3 interest rate cuts next year, because that really took me off guard.
Now, as far as I know, the signal is in the dot plots and nowhere else, right?
Yeah.
I mean, I didn't see it anywhere else. I didn't see it in the statement.
No, but we'll see what like the Fed watch tool is going to indicate as well. And if you look like 1 month ago, the expectations were that there was a 21% chance that the Fed would continue to raise rates right into January. And the first rate cut wasn't until June and December. And then all of a sudden you come out with 3 rate cuts. You get this risk on rally. It's in almost all markets right now. I mean, even oil's up 1%. But think about this. If you go back about a month ago, 2 months ago, and even into the summer, everyone was anticipating that the economy is going to crash, that they're going to over tighten so much, it's going to break the economy. So everybody shifted out of the risk assets. They liked the bounce back that they had in the equities from last year's lows. And they were saying, man, 5% on an I-bond, get me out of these risky assets. Let me front run the crash that happens, and I'll go into these nice 5% highly liquid, money market funds. And that's where they're at. And then you see this type of event occur. Everyone's going to scramble out of it because shoot, last month we were up over 5%. So just by them doing that, it really cost them a disservice. Now they're going to scramble in and they're going to project this thing even higher.
So the Fed funds rate right now, the effective rate, what do we call it? 537, somewhere around there, 537 and a half. It's a range between 5.25 and 5.5%, right? That's where it is now. So if they put 75 basis points of cuts in, we're talking about 4.25 to 450. Is that low enough to say, you know what, now I don't want a riskless asset, in your opinion?
It depends. Well, I mean, I think that you start to see these other asset classes inflate. I mean, just while we're on on this conference, you're seeing a couple percent move in gold and in silver and, Bitcoin and everything else. So I think it's a matter of things start to come down. People start to really get concerned that they need to get into these other assets.
Looking at the NASDAQ futures right now, live chart, we're about, well, I may be wrong now. Looks like we might have gotten a new all-time high in the continuous NASDAQ futures chart. And that to me seems overdone. I'm not going to say that because you knew it was coming, right? I mean, when you see something like that, it is definitely the kind of thing where this to me doesn't feel like short covering. It feels more like sort of new, not new money, but just an addition to things that could be driving markets higher, like you mentioned, all the risk assets. So I guess it now comes down to Fed speakers. So from a perspective of metals, where do you see the biggest sort of hint as to what's going on?
Well, I mean, if you look at how gold is, you go back and you look at the higher lows in gold, the 1850, now like 1950, now today prior to this meeting, that was probably the next recent low that we've seen. The market is pricing forward now these 75 basis points of cuts. So
Right.
besides the hit job that we saw, like that December 4th, that Sunday night breakout to the upside,
Yeah.
2 contracts traded at that 2152. I'm
Was
just
that
hoping
two?
that it was just 2 contracts at the high. And I mean, you got to not trust. I always tell people that Sunday night trading is for taking profits, booking gains, not and reducing positions, not establishing new positions because it's just such a thin market. I mean, you go back to 2011, 2010 when they killed bin Laden on that Sunday night. That was when silver prices breached $50 and then it was a cataclysmic fall from here. I think that gold and other precious metals, they're going to continue to rise based on these cuts. We could see gold futures go up to about 2350, but you're going to need some other elements to it. The rate cuts alone aren't just going to do it. And also, who cuts first is another part of this game. It's like a game of chicken. We saw UK GDP really miss. We're seeing the ECB, they're really signaling some concerns over here. So if all of a sudden, the British pound and the euro currency, those guys cut first, it's going to boost the dollar up and that'll actually weigh in on metals. Metals could have a bit of a hangover. So it's really who cuts first that causes that volatility. If the US cuts first, it's going to propel gold to that higher level because of the inverse relationship.
So just since we're talking about gold, and you can see Jimmy's here right now, probably still doing some trade reconciliation, but just so we're talking about gold, let's talk about that December 4th move. Clients obviously called you, right? And said, what the hell? What's your answer to that? Because people called me and said, what the hell was that? I'm like, what was what? I mean, I looked at it and I just kind of blinked. I'm like you said, Sunday nights are nothing.
Because it went up on really nothing. And every single one of these Sunday nights, these Friday paint up into the close, expecting some escalation on the geopolitical front. Technically there was a wedge and a breakout to the upside, but that was just thin trading, a lot of stops getting hit. My phone was ringing and I was telling people, I bet this thing will be negative, by the time the morning comes around. And I seen, a lot of different companies, like one of the reports here, TD Securities, they put out a short recommendation selling gold at 2070, targeting 1950. Doesn't look like they're going to get it. But on the silver front, they were shorting 2551. They put in a target 2445. Well, silver blew through that. So once you get these kind of momentums going and these emotional plays, you start to see prices really overshoot to the upside and the downside. In order for gold to really get that, like I said, 2350, because now it's got another higher low on the charts.
Right.
You're going to need to see ETF demand come in, which it was at a peak level and peak long on that Sunday night move, and it seemed like all of that eviscerated. You probably need to see a wider spread conflict in the Middle East as far as geopolitical, not things we want to see, but it's just the playing on the emotions of people. You might see some kind of China, Taiwan, things like that, this Russia-Ukraine thing not going around. So that geopolitical part of it. And then I think that people in China need to look at gold as an alternative investment because of the fact that everything they basically own is deflating right now. Maybe they could find some kind of stability in an alternative asset like gold.
Jimmy, I want you to know I didn't let you down. I did complain about the level of our pictures.
So good.
You weren't here. Yes, I didn't let you down on that.
God, I'm sorry about being late, Phil. I'm sorry about all you guys watching too. It just, after that FOMC meeting, the shit absolutely hit the fan on the trading floor. Phil, I wanted to ask you about something. So part of my gold thesis for the year, and obviously what a great day to have you on. Gold's up, what, $35 after the Fed? 75 basis points of easy next year, which means they're just coming closer to what we think. One thing I've been watching all year is central banks adding gold. I don't believe in the dollar is dead theory. I do believe that the chances of the dollar being dead over the next 20 years have gone from 2% to 6%. That's just, completely pulled out of the air. But I do think it's enough that people start hedging themselves in case there's some sort of dollar distress. Have you been keeping an eye on what central banks have been buying gold over the year? Do you worry about the dollar?
So the dollar demise, I really don't see that happening. I do think that people are seeking alternatives like the resiliency of how good Bitcoin and Ethereum, are doing. I really thought that those cryptocurrencies would have died off and be gone, and it was just a fad like an NFT, but they're really hanging in there. So it shows that there are alternative currencies that are out there that are needed. As far as central banks, I really feel like the global economy, I feel like we were kind of one where everyone was kind of trading partners with everybody. And then you start to see these conflicts occur, the Russia-Ukraine, this Israel, Hamas, and people start to choose sides. And what it does is you start to see all these backdoor meetings between different leaders. You're seeing, just different countries meet up that historically normally wouldn't. We've seen, Putin, he's with the Saudis, and we're seeing North Korea meeting with Russia, and everyone else is kind of separating themselves and are saying, okay, we need to park capital. Let's park it into a hard asset. There's no real need to be holding, US dollars, especially if, they're perceived as America's perceived as some kind of enemy right now. And people want to get away from it.
So you don't think, because I've been saying the same exact thing. So you don't think it's hyperbolic. You don't think it's overdramatic to say that everybody, the hair on the back of their head is standing up thinking that what's going on geopolitically. So what's then your target on the upside of gold if things to accelerate in this awful direction we're in?
If they accelerate it, I really think the 2350 to the 2500 level. I mean, things will start across the board accelerating. Inflation will pick up again, and we might see a higher low in what these interest rate cuts are. So if we get down to, bare bones, and now all of a sudden the new hook low is 4 3/4 because they're pricing in 3 cuts, who's not to say that all of a sudden the Fed doesn't start another hiking cycle again, and we end up at 6% because of the fact that inflation's picking up again.
I want to throw in there before we go on that if any of you guys watching live have any questions, you can feel free to type them in. We'll get them asked and answered. And like Phil said early on in the show, Jimmy, before you chimed in, that all of these things come together to form the basis of the whole economic thesis of the markets, whether it's equities, ETFs, individual stocks, all of this stuff is tied together, which brings me to the question, Phil. The talk about what the U.S. government banned private ownership of gold, I think it was in 1930, somewhere in that range.
All right.
There are some people that say they could do it again. You're smirking already. So tell me, I know that smirk. So tell me what you think of that kind of a conversation, because I own gold. I own physical gold. I'm long gold futures, and I don't plan to stop on either thing.
Pry it from my dead cold hands. I mean,
That's the right answer.
you're not gonna get it. You're not gonna, I mean, the last No, I've heard a couple in different countries. I've heard a couple different things where I have friends that live over in Europe, and two things I've seen where, you register like a firearm with the government, and the particular person, their grandfather owned a farm, and he had a shotgun that he would use for, if anything, coyotes killing off his cows and stuff. And when the guy passed away, literally the government officials knocked on the door and said they had to surrender the firearm. So that's like, that was kind of modern. I've like, that was the first time I heard that. And I know another person that lives over in Europe, and the particular car that they had that was registered with the government was putting out too much emissions and things like that. And they just said that, hey, after this certain date, we're banning it. Now, is California going to go over every gas car and just, seize it?
They want to.
I know they want to. So, I mean, it's a matter of, hey, is it kind of registered or is it not? And then it gets a little dicey and things like that. But I just can't see that they could do something like that. They'd probably take all your Bitcoin before they take your gold.
Easier to take in theory, right?
Yeah.
And that's the funny part to me is I love the way you express that, because one of the things that we talk about a lot on both our shows is this idea that anytime government is registering something, the only reason is to know who has it. And the only reason to know who has something, whether it's Second Amendment with firearms or whether it's gold or anything else, is so that they can track it and take it. And anytime they do something under the guise of security, it generally is not for our security. It's for somebody else's. So looking at it from that perspective, I think that makes gold more valuable. The idea that that could actually happen. And is there a same sort of relationship with Bitcoin in your view, or no? Is this part of the reason that people want to flock to Bitcoin thinking the government can't take it?
So the problem that I've always had with Bitcoin is that every time you hear about a ransomware attack, someone getting hacked, somebody getting, whatever, taken advantage of, always the way that those problems are reconciled is in a cryptocurrency like Bitcoin. That's why I've never liked that asset class. But I do see the benefits of it. Like if you had to send somebody who was doing some religious, as far as like trying to spread religious beliefs that was approved in another country, Christian beliefs or something like that, and you needed to get them money in a fast, efficient way that they can convert to local currency, it does make sense kind of under the radar. Something that I do fear with us talking about registering things is if they went to a digital dollar, what if there's no more US dollar? And all of a sudden the Fed's looking at how many dollars or the IRS and things like that you have, how you're compensated, and everything's digitized. That would, that could change the taxation. That could change everything.
So Phil, can we pivot to copper for a second here?
Sure.
Okay. So copper, in my opinion, has held in remarkably well, considering one, China, we used to call them Dr. Copper, or Dr. Copper told us what China was feeling, or whatever the hell that was. The news out of China has been nothing but bad. Copper's held in. Interest rates have stayed high. Copper's held in. If we get a new administration that starts moving us away from the green energy pipe train, and at the same time China continues to deteriorate, is copper going to go through the floor or not?
Yeah, I think it's pretty much toast then. That's where you're going to see sub 350 copper. But the way we look at it right now is that we believe that there's an inherent, like there's the left tail on copper is really limited. So from this 370, down into the high 350s, we think that that's limited because of the green energy. We think that China, there's kind of an inherent put in there, like how bad does it got to get before they tend to are going to come in and provide some real meaningful stimulus? How can they fix their property sector and things like that? I was reading somewhere that they suffer from debt and deflation, and they need to focus on rebalance and reflation. And that's where we could get those prices a lot higher. I do like copper. I like the way that there's a much smaller contract right now. it gives you kind of that barrier to entry. Is a lot easier for the small retail investor. Something else that's a bit of a wild card on copper is we've seen multilateral agreements between copper mining organizations that organize a strike together. And that was the last time we saw copper go up to about 392. You had 7% of the global copper offline due to a strike. So a bit of manipulation, yes, but I think that copper's in this big trading range right now. We like it anywhere below like 370 down to about 355. I would say below 350, it's probably party over. Something dramatically had changed in the markets. And then again, anything over the 390s into the fours, I think you lighten up.
So, okay. So that, I guess, answers my second question, because I was going to say, to me, it looks like it kind of almost could be coiling, waiting for some good news. And there's a lot of bad news priced in. But you still think you lighten up over 390, 395? Is that what you said?
Yeah, I think so. I mean, you don't want to be greedy in these kind of markets because things can really, what if the Fed does come back and tighten? China, like you said, what if they never really pick up? They're complacent where they're at. I mean, China's making a lot of side deals with other South American countries on things like agricultural products and stuff. So they don't necessarily need to, be taken off they just need to like fulfill their current needs right now is I think how they look at things.
This is crazy, guys. Just want you to keep you updated. We're looking at a 447 2-year now.
Jesus.
Basically down 1/4% from where it settled yesterday, down 1/4% on the 2-year.
And I'm long that steepener, and I explained why yesterday.
Yeah.
And I said one of the base cases was that all of a sudden the Fed kind of flips, and they did a little bit today. And granted, it's only nascent in the move, but it's moved like 5 basis points.
No, but this is what we were talking about when we had the original pivot conversation, right? This is a pivot.
This is the pivot. Yeah.
This is the pivot. We said that they had to pause prior to pivoting. So to you, Phil, my contention has been that one of the sort of hallmarks of Jerome Powell Fed is they say it before they're going to do it. Does this qualify as them saying it?
This is definitely, I mean, I didn't look at the devil's in the details, and we've seen it where he's made these kind of hints, and the market makes a dramatic move like this, and then all of a sudden we get 2 or 3 hot data points, and then he has a speaking engagement somewhere, and then it becomes all eyes on that, and things reverse. I mean, I definitely like the upside, but when you start talking about all-time highs and are still that threat, that that looming cloud that people talk about into 2024. I mean, why are they doing it now? What are we not seeing that is really going to happen that's so dramatic that they had to do it right now at this meeting here at this time? That's what people are going to weigh in on.
Yes, but when people say that, I think that they're full of shit, because I don't think the Fed has any greater knowledge other than a couple weeks out, perhaps, than we do. I just think it's, the PPI numbers are lower depending on how you calculate inflation. It's kind of dissipated quite a bit. It's always funny because I hear people say that kind of stuff all the time. Maybe they see something that we don't. They don't see shit half the time, do they?
They use a rear view mirror for all of it.
Very well. Right.
I mean, you drive forward and you're driving in your car and you're using the rear view mirror to indicate your direction. You're going to crash. So.
Yes. Oh, let me ask a real
funny thing to me about this, Jim, real quick, just because we're talking about it right this second, is all we hear people talking about is how strong the labor market is and how services inflation is sticky and how wages are still growing. And the Fed is basically, according to all 3 of us, so there's a unanimous consensus here, has basically said it's time to cut rates from a level of rates that doesn't seem to be hurting. That's the thing that confuses me.
You
when
know
I see
my opinion on that.
I
We
do.
talked about it again yesterday, is that everybody had the opportunity to roll into duration in the 5 years prior to the beginning of the hiking cycle, and they did. So everybody's sitting on their hands going, wow, sucks to be you if you need a new loan. So it kind of stood in the way of the efficacy of the Fed rate hikes, which I think is pretty interesting. But for you guys, for the people who are watching the show, what happened today, what caused the markets all to go crazy, was the dot plot, where the Fed now said that they themselves expect 75 basis points of easing in 2024. We, the market, has said as high as what was the highest you ever saw it? 140 in 2024.
Yeah.
But now they're starting to converge with us and saying like, yeah, you guys are right, rates are too high. But that's just my 2 cents.
Well, again, and I'll put this to Phil, from a perspective of that, if the Fed is saying that, we need to see evidence, and I think this is what Phil was saying, we need to see evidence that we are moving towards 2%. Yet their prediction for rates this year, or for inflation this year, is 2.6, and next year is 2.4. What?
Yeah.
So it kind of, and by the way, I'm not disagreeing with your thesis, Jim. It kind of points to, and this is to you, Phil. Do you think that they're legitimately, are they confirming that they're legitimately that afraid of an asset devaluation that they're going to be blamed for? Because otherwise, I don't see any reason.
Jerome Powell got into his car. He had to get gas. He saw it was $3.20 a gallon. It was better than the $5 he was paying. He's like, we won this thing on inflation. We don't have to do any more. So that's why
I don't think like we say that facetiously. I think that kind of thing happens, just to be clear.
30-year fixed mortgage rates have declined for 6 straight weeks. I mean, that's going to be a big part of, CPI. So a lot of things have come down quite a bit. Crude oil back below $70. Grains can't catch a bid to save their lives. You got a couple one-off commodities that are up substantially. OJ up 116%. I haven't bought orange juice, and I only use this much for a mimosa on Sundays, so it's not impacting me. Cocoa up 60%. With it being warm and sunny in the Midwest and everything, I'm talking to farmers, and they're going, I'm in a t-shirt and jeans. There's no hot cocoa demand, and there surely isn't any natural gas demand. That's down 60% right now. So I think that these commodities, the bulk of them are sliding lower. You got a couple outliers here and there. The inflation thing is one. I think they're happy with the job market not completely falling apart on them. Yeah, you do have ISM services expanded for, the 11th consecutive month. So, and the credit thing, a lot of people talk about credit. That credit growth is actually starting to slow down. I mean, I know like from us and a lot of people I talk to, they're really not spending as much as what they once were. They're realizing that, hey, they got a little bit back on food costs and things are starting to come down. They're concerned, so they're socking away a bit of that money rather than blowing it on additional things and expanding more credit lines.
To that point, my restaurant, we noticed like 3 or 4 months ago, the same amount of foot traffic was coming in, but each one of those people were spending less money. They were making different decisions. And where I am out in Palatine, the restaurant, it gets all different socioeconomic classes, including the Inverness and Barrington crowd who have decent money. So it was odd to me. I want to talk real quick about the silver catch-up trade. Mm-hmm. Is that the three of us all trade both these metals, yep. And the book always is that gold starts to rally because people can't really figure out if silver should be strictly a precious or slide more over to the industrial. Gold goes, they separate. Then all of a sudden, people are like, shit, gold's too high. What should we do? We buy silver, and then silver dramatically catches up. We had that chart up a couple shows ago, Bobby. When was the last time we did that? Was that like 2020 or something?
Yeah, something like that. I could probably see if I can find it.
And today, the only reason I bring this up is today when I just looked at my board, gold was up almost 2%, silver was up almost 4%. Is it upon us now, the silver catch up?
If you're asking me, Jim, let me put this hat on. It says "Make silver great again." So silver, realistically, and I only busted it out because I felt like it was going to go up $1 today. That's the only time I wear it. But we're up about 92 cents at the moment. Realistically, I think upside without anything crazy, without the kicker is okay, silver could probably go $26, $27. You need gold to go to, back over to 21.50, 22.50, 23.50. That's how silver gets to 30, 40, and everything else. What people fail, though, to realize, and I talk to a lot of old timers that invest in silver, they look at it as that monetary thing, as that coin that they hold. They've got this sense of security. The reality is, though, is that 54% of silver's demand is industrial demand. So you need to see that pickup. The bottom end on silver has come up. I don't think we're going to see sub $20 silver because Mexico, who's the world's largest producer, has increased regulations on the mining industry right now. You need where we talked about copper, you do need that solar and that green energy needs to help support prices as well.
So that's what I was going to ask you. I was going to bring up silver as well. First of all, how important is the gold silver ratio? And second, what has to happen for that industrial part of silver to matter? And I guess you sort of answered it, but one of the things I'm always trying to figure out, and I don't have it figured out, what is the balance between precious and industrial in terms of what drives silver? Because I don't see silver playing catch up when manufacturing is strong, because the precious side's getting pressured. So that's confusing me a little bit.
Dude, that is tough. And you mentioned that gold silver ratio. Every time I write about it in articles, man, I get like so much hate mail because it's trading in this range right now where it's like 80 on the downside, 86 on the upside. Currently, right now, we're floating right around 85 to 1. Historically, though, people, depending on how long you've been involved with this, if you're like a real old timer, you're thinking like 25 to 1, 40 to 1. You know, I know the days when it's like 40 to 60 to 1. And when it gets over 100, 120, which we've seen that before, you know, that's just ridiculously cheap. So I think that when it comes to ratios, it's tough because silver wears those two different hats. Silver's a refined product from mining copper. So I think that they're more closely correlated. But the problem is that you go back to these people that, you know, the 1964 coin collecting guy, and he looks at silver as that poor man's gold. So there's that correlation there. So I don't think that there's any real right answer on it. You can make correlations between anything or ratios on anything, but you do definitely need to see, you need interest rates being cut. You need gold prices going up, the dollar sliding. And then the kicker is that China, all of a sudden, their industrial demand picks up, copper takes off. Remember, China's the #1 consumer of copper. That takes off, and then that's the gas on the fire, and silver hits that 30, 40, 50 bucks.
Okay, that's really interesting. I wanted to make 2 points. One, the 2 different times you said old timers, you realize you're talking to 2 old timers right here, just to be clear.
My birthday is tomorrow. I'll be 45, so I'm joining the old folks.
Right? But we are longtime veterans of that old timers.
I can't believe we could drive when he was 4.
Exactly. Yeah.
Go ahead.
But something you just said, I think, is very interesting because you laid out the silver catch-up. Because in my head, the silver catch-up is when people say, forget this industrial side. There's a bit of a panic. Gold is stretched. Let's buy silver as a panic just for the precious. You're saying that kind of exists. And what happens, the kicker to give it the crank, is other parts of the world have the industrial demand. That's fascinating to me. Thank you for that.
Oh, no. Well, and here's the thing, though. We're saying that like silver's going to catch up. Silver's up 4% right now. Gold's only up 2%. So who's catching up to who at the moment is the question.
And everybody here knows that I am long silver, copper, and gold out the ass. And so I'm feeling good today, which it's been a long slog. But anyway, Bobby.
No, and I appreciate you pointing that out because people don't operate in percentages. Like I had a friend of mine who's in the military called me the other day and he said, so I wanted to buy gold or silver. Which one should I buy? And I said, well, considering, I'm not going to go into what he does in the military, but I said, considering what you actually do for a living, you should probably own gold because you could transport more of it. It's much more transportable in terms of the amount of money he needs to carry sometimes for whatever he needs to do in the Middle East. Not important.
But use her to kill people, don't you?
Yeah, I'm just not. That's just not. But silver on a percent, when silver makes up, I mean, he was better off buying 9 silver ounces than he was 1 ounce of gold. If you look at the move today,
here's something too: is that gold is a currency, silver is a commodity. The maximum position you should have in any one like real currency, everyone's going to be a little bit different. I say like no more than like 10% of your net worth in a particular currency position, you know, whether it's pounds, euros, gold, things like that. From a commodity aspect, because of the increased volatility, that really should be, you've got to define your minimum and your max. That really should be no more than like, say 4 to 6% because of the sheer, you've got to volatility adjust the positions.
I find it interesting that Bitcoin and Ethereum are both up significantly too, but silver is outperforming both of those to the upside, which that's to me is quite rare. Those things are volatile as hell. They lost 10% one night the other night.
And that brings me to my question. Is this kind of the perfect storm, Phil, for silver? Because obviously if they're going to be cutting rates, we're going to be getting more manufacturing activity. And if the dollar is going to be devalued by the rate cuts and yields are going to go down, we get the kicker from the precious side of it, or no?
You got to have China. China's got to play a role in this thing in order to get that explosive move. I mean,
I'm comfortable with that though, because we've priced in a lot of bad news in China. And they've come off the canvas before. That could happen again. I don't think that that's too far out of the realm, do you?
No. It's just they got to come into it. They're one of the largest consumers. I mean, every single thing that the way silver works is because 54% is industrial demand. It comes out of the ground in Mexico. It gets shipped over to China. They make this little cell phone. They make this, which has all got silver. Everything down to the remote's got silver in it. And then that gets all distributed. And then anything that's left over is bought from jewelry and coins and everything else.
So, Bobby, I'm going to ask you a question, unless you want to weigh in on the stock market too. Risk assets obviously love this today. It's funny is that this caught me off guard where for 2 years I said stocks can't rally until the Fed pivots. The Fed was pivoting over the last 3 weeks, and I kept thinking, nah, this isn't it. This isn't it. So I've missed it. Are we going to all-time highs now or no?
Well, again, I mentioned it a few minutes ago. The NASDAQ future has. The NASDAQ future, according to my charts, if you're looking at the continuous chart, has hit a new all-time high. So again, technically, if I go by my textbooks from 1984, we are now in a NASDAQ bull market. And let me explain that because Phil's going to roll his eyes at me. But you have to get a new high in order to declare a new market. Otherwise, it's just a move in an old or in the bear market that happened after the all-time high. So you now have a technically correct bull market in the NASDAQ futures. Now, whether that happens in NASDAQ cash or not, I don't know. Our friend Mike Singleton from Invictus said that he expects this to be pretty strong resistance and he'd probably be selling up here. He didn't give an actual sell recommendation. He just said that that's probably what he'd be doing. So from my perspective, and Phil, this is to you as well, if they're easing, they see weakness. And is that good for the stock market? So kind of medium term, because short term it clearly is.
I think it is right now, but I mean, I'm telling you, there's too many people that went to cash, are in a 5%, they bought some BlackRock money market fund thing like that. And now they're going, oh no, like I was really safe with that thing, but holy cow, I mean, you could have made it probably I don't even want to, I got on NVIDIA a week ago or whatever. And I'm like, man, that thing's probably going up again, on this kind of move. So those are the things you got to weigh in. It's also the FOMO. I mean, people might be like, we're back. Tesla's back. I mean, I haven't looked at the Magnificent Seven here today, and see how that's going. Or what about like Goldman's most shorted basket, things like that. What are those doing, at the moment? So this could be another risk on rally. And if those bigger stocks, those large caps start to stall out, the best performing, I looked at the last couple times that the Fed raised rates aggressively, and then they went into this massive cutting. It was always the small caps that did the best. And if you look at the Russell up 3% right now, it's up 64 points. I mean, it's blowing the socks off of, the S&P, and NASDAQ's up a piddly 1% right now. So, that thesis might be true.
Jimmy, I did just look at the QQQs as a proxy for the NASDAQ, and they're still about 1% away from the all-time high.
Interesting. So this is fascinating to me is that we always talk about how the NASDAQ should love when rates are lower based on that discounted cash flow model that Wall Street uses. But several different times when rates have gone lower, the NASDAQ hasn't done as well because that's just we're saying that the IWM, the Russell, has been so punished that it has more room to coil on the upside. By the way, is Phil frozen to you, Bobby, or no?
Yeah, that is definitely not the way he sits.
No.
There he goes.
Well, there he's back unfrozen. Yeah.
Sorry. I was looking at the price action and I just froze.
No,
You were literally frozen like a Stevie Wonder in the middle of a song where your head was going like this.
no, but you hear what I said is that it's just a function of the fact that the Russell has been so unloved, so punished, and it's got to play some catch up.
I got to tell you, I asked a hedge fund research company at one of these conferences that, like, okay, if rates are up so high, why are these companies that rely heavily on debt and things like that, why are they taking off? And and you think because they borrow, but it just seems like there's an endless amount of capital that they could tap into. Like, chances are that, like, SpaceX and things like that, that company's probably not worth whatever they're stating it at. I mean, you make a rocket, it goes up, it blows up, you just lost like $1 zillion, and hey, all the research that went into it, chances are half that's no good anymore, because why did it blow up? So you got to go back to it. But these guys can go out and all of a sudden they can create more shares, sell more shares, borrow more. Hey, we'll become profitable at some point in time. And somehow the stock goes up because people want to be part of this thing. I think that's the reality. But in a low interest rate environment, all of a sudden the small business owner, the guys that make up the Russell, those people are all able to borrow and things like that. I mean, God, people got to be mortgage brokers got to be licking their chops going, we've seen 6 straight weeks. Well, this is going to be the cliff coming off. Now, all of a sudden, you might get a little bit of action in the housing market.
Hey, Jimmy, this is something I asked Phil before you got in here. I said, so they're talking about the effective Fed funds rates about 5.37, right? And they're talking about 75 basis points of cuts. Right. So you're 4.25 to 4.5 approximately. Well, no, 4.5 to 4.75. Is that enough?
No. Well, here's the problem I have with the market pricing in 100 basis points, them pricing in 75 basis points. All of it presupposes that they're going to look at the market and go, yeah, things are, a little too slow. Let's ease things up a little bit. That's not the way it generally works when the cuts begin to come. So I'd be more comfortable, and I know the market has to come up with an average. They have to come up with an average, but realistically, it's 0 to 25 basis points of cuts in 2024, or it's 200 basis points of cuts in 2024, because when they start easing, it will be because burning timbers are falling from the ceiling. That's just my opinion, but that's always the way it's been in the past. By the way, I'm not even 100% sure of that opinion. Like, I'm the needle, that's just about right here. Do you guys think that that's reasonable?
When you were just mentioning the cuts, I was thinking, when you're talking about like gold, how does it make those higher highs, like the 2,500, or silver really hits the $40, $50? What if the Fed makes insurance cuts? Like, instead of going like, hey, I know we said 25, but we think things are getting a little bit even more sketchy. Let's rip the Band-Aid off and just do 50 right out the gate. I mean, they were raising 50 on the way up for a while. So what if they just try and get ahead of it because something bad is really happening? I don't know. I'm just kind of throwing it out there that there's that insurance cut thing. And then now that we got cuts in play, where are the new lows on equities? Because all of a sudden the Fed put comes into play. There was the Powell put or whatever we were talking about, at one point before that's here now.
Bobby, I have a question for you.
Yeah.
Do you think rate cuts have quicker efficacy to work their way into the market than rate hikes, because the wealth effect works better than the de-wealth effect, or whatever the hell you'd call that?
Talking about the stock market, yes.
Well, what about that macro condition?
We're seeing it. The interesting part to me, and it applies to that question, is when you're looking at these markets now, we just said that the rates are going to go to 4.5, 4.75. Okay, that's still going to be the second highest level of rates since about 2008, right? And the interesting part, to Phil's point, is they say they're not declaring victory. They've said higher for longer for 6 months now, 8 months, something like that. And now people are expecting them to cut in 3 months. What if they don't? And what if they just say, like, look, rates are good here. The economy's still strong. What is the market going to do? And, that's why I think Phil might be right about that, because an economic downturn is sort of like going broke, right? It's gradual, then all at once. And when we see that in the economic data and it starts to collapse, especially, I hate to be the one who says it, but going into an election, right? I think Phil's right. I think they're very likely to cut aggressively.
Bobby, I was just going to say that, well, Powell filled up at that 320 a gallon and his Slurpee was a little bit less. He probably got a call from the White House and was like, look, we got an election year. You got to cut 3 times, bud. We got to get this economy going. We got to lift the little guy back up, stuff like that. So
are you joking, or do you think that really happens?
I mean,
maybe not.
They're supposed to be data dependent and independent, but man, I don't know.
Probably the Slurpee.
I say look for the bad in everybody, and you won't be disappointed.
I'd say the Slurpee he's serious about. Maybe not the call. It probably comes by a guy in a suit that walks by and says it while he's on a bench.
Cut rates.
Cut 75 basis points.
Oh God. Yeah, from that perspective, I do think that cuts go into the market quicker. And the interesting point is, if they cut aggressively, the market, I think, is going to initially assume that something's really wrong. Remember what we said about 15, 20 minutes ago? What do they know that we don't? The last time the Fed cut aggressively, we were all on the floor and everybody was saying that. Everyone's going, what do they know that we don't? And people were selling everything for a couple of days.
They're going to have to look at where the economy is when the cut happens. So if the cut happens and the economy's not doing that bad, it's not falling apart, maybe all of a sudden you get that projection where it goes from the 3 to only 2 cuts, and it becomes like the buy the rumor, sell the fact. I mean, this is probably peak hysteria at the moment. Like, anybody who's getting out of work is going to be like, did you hear what's going to happen? They're cutting rates 3 times. I mean, this is the greatest thing ever. And then it's like
real jobs, not like us who sit around and watch numbers on the screen and shoot the shit.
Yeah. I mean, like, realistically, I mean, like, the mortgage guy going, there's going to be 3 cuts, and he's trying to drum up some business and stuff. And then all of a sudden only, 2 cuts occur, who knows? I do know one thing is that Jerome Powell in the past, not to criticize him, but sometimes he tends to be a liar. They stopped raising rates and things were still heating up. Inflation was still way too high, but they had already stopped raising rates, 3 meetings ago. And we still saw a pickup in a lot of activity. The labor market's still pretty tight. I mean, unemployment's 3.7%. We just added 199,000 jobs, and there's no reason why they shouldn't still be tactically, hiking. It's just whatever they're preparing for, or they really got the call from the big man.
That's interesting. And I think it's possible that they did. Bobby, before you ask a question, I'm going to ask you a question. Back in the financial crisis, with the Fed wasn't, and this is, I honestly don't remember, they weren't ahead of the curve. That was the Jim Cramer, they know nothing shit, right?
Yeah, way behind the curve.
They were way behind
the curve.
Yeah.
And, the interesting thing about what Phil just said, look at this particular meeting, right? And all they really did, okay, and if you look at, by the way, the dot plot breakdown, it was only like 5 members that had 75 basis point cuts in there. They just happen to be the majority.
Right.
Okay, so, and the committee's going to change more dovish when the year changes. We got Raphael Bostic going in there. We got Thomas Barkin, who has been hawkish lately, but is known as a dove, right? So they're about to get more hawkish. Mary Daly, I said yesterday, I'm assuming she's dovish just because she's from.
Yes, she's dovish in an election year when the Democrats in the office. I'll guarantee you that. Lyle Brainerd is wildly dovish when the Democrats in the office. These people are political. Yes.
But like what? Who's to say when you look at, say, the Fed Watch tool? If you guys don't look at the CME Fed Watch tool, you should. This is more of a stock show, which is going to lead me to my last question for Phil when the time comes. But from a perspective of tools that you can use, you should be looking at the CME Fed Watch tool, because they got 3 very important tabs on the left-hand side of it when you open it up. First, you get the current, which is the current rate, the probability on the next meeting of whether there's going to be a hike, a cut, or nothing. And then there's a compare tab where you can see where it was from the prior day, a week ago, 2 weeks ago, 3 weeks ago. And then what I see is the most interesting tab is the probabilities tab. And when you click on that probabilities tab, you'll see the next year out and what the market is pricing in. And that's why, we used to have to do the math, and now we can just look at that. And all 3 of us are financial news contributors. And we go on our shows and go, yeah, the market's pricing in. Everybody's going, wow, those guys do great math. I just look at the website. But from
I
that
used to do
perspective,
that, but anyway.
I'm counting 1, 2, 3, 4, 5, 6 rate cuts that the CME Fed Watch tool is now pricing in as of 15 minutes ago, because it's delayed. 6 rate cuts in 2024. Taking the rate down to 375 to 400 by December is the highest probability.
Jeez.
Okay. What has happened since the May rate hike, or the May pause, I should say, of this past year, has been that they have priced in cuts and they've just continued to shift it, continued to shift it, continued to shift it. Eventually, they're going to be right. Right now, they're starting to price in more aggressive cuts. That hasn't happened so far. So if for some reason the next batch of Fed speakers starts to say, look, you guys took this wrong, right? And Powell's too much of a wuss to do that in the press conference, right? The only time we ever saw him aggressive in either direction, whether it's dovish or hawkish, was Jackson Hole.
The Jackson Hole beatdown.
Yeah, that's it.
It's
But
crazy.
you might see,
They're crazy. We're hiking.
we're going to know from the Fed speakers that are coming if they're actually doing it, or if this really was just, hey, we're not hiking anymore. And a couple of the guys think we might ease. But again, it's going to get more dovish next year, not less.
That's what I believe too. Phil?
I'm with you on that same camp.
This is interesting. I put out something yesterday for a client of ours where I said that the Fed could actually affect crude oil prices, and crude oil is up $1.65 as well. Yeah, it's up. I'm sorry, that's 1.65%, up $1.13. Now I can't change the dynamic until the rates actually get cut. But if you start to get manufacturing moving because rates are going to be lower or are lower, and Phil, the mortgage thing, do you think people actually look at it and go, well, they're going to cut 3 times, so I won't do anything now. I'll wait for the third cut?
I think that people are kind of doing that. They're definitely kicking that can down the road as far as buying houses and things. There's not, where I'm at, this was like one of the hottest real estate markets in the country, and in the Panhandle in Florida, because it was kind of the untapped area. And now it's like properties aren't really moving. Prices are getting slashed right now. Going back to crude oil and whether or not, the Fed can move crude oil prices, I really think that just like gold heading into that December 4th blow up top, everybody was aggressively long. It was like at its 97th percentile for long. Now on crude oil, it's on like the 97th percentile of the shorts and the bears in there. And you look at Saudi Arabia can't balance their budget without $82. OPEC, realistically, most of those countries need like $85. So I think that there is an inherent put in place on crude oil from here. Not really a real recommendation, but I think you got to be kind of long crude oil, but it's tough for the stock guy to pick something, because a lot of those ETFs are front loaded on those closer contracts. But realistically, you want to be long crude oil from like June out to December of next year. Those are the contracts that I think that are flattened out. And now those prices are higher than the front month, because after the Fed gets done cutting, there'll be a little bit more or starts cutting. There's a little bit more disposable income there for people to be driving around. They don't want to blow their money on overseas trips, but I think that these kind of localized, road trips are in play.
Bob, you got a last question?
I do. So being that this is more of a stock crowd, more of a cash asset crowd,
We're trying to cure them of that.
Yeah, we're trying to cure them of that. But I mean, the interesting thing, like you said at the beginning of the show, Phil, it's all tied. And that's why we wanted you on this particular show. From a perspective of, do you have any opinion of miners versus an ETF with metals? In other words, well, you go ahead. I mean, you know which ones they are.
Okay, so like when you talk about like a miner, and if you're going to compare like GLD, SLV versus a miner, you have to remember, what are your goals with the particular trade? Because if you're buying a mining company, you're buying just that. You're buying a company. You want to think about what you're buying. Watch that show Gold Rush or something. That's a much smaller scale of what you're investing in. It's property, plant, equipment. You have things breaking down. You have all kinds of issues. One of the biggest, I'd say the 3 biggest costs for a miner are your labor costs, which have been dramatically high. Everyone's getting paid insane amounts of money. Your borrowing costs, which, okay, they're getting some reprieve here today. Your insurance costs, that's another one. And then also your fuel costs, those are all at elevated levels. They're getting some discount here. But the reality is that what was your goal of going into that miner in the first place? Chances are it wasn't you in love with the management company, things like that. Your goal was to be long the underlying precious metals. You just want to buy gold and silver. And then one other factor that I just thought of was many years ago, I bought a mining company. It was a silver mining company, and they were overseas. They were in South America. They had struck it rich. The stock went from like $2 to $20. Overnight, the government, this is a South American government, said, no, the company doesn't own anything beyond like 5 foot below the surface, and they nationalized it, and the stock crashed.
Wow.
Remember, you do have these different country geographical risks that are in there. And also something with a miner, if you think it's a silver miner, chances are it could just be named like Silver Mining ABC, but the reality is the bulk of what they do mine is copper, zinc, lithium, other things, and silver just makes up a little portion of it. So it's really the devil in the details when it comes to these mining operations. I think you need to be much more sophisticated to invest in miners than you do in something simple like Apple that has 3 or 4 products and we're just counting how many widgets they're selling, each month. So if you really want to be involved with precious metals, I would say start with the ETFs. I really like the smaller futures contracts. Nobody who was involved in a mining owning a mining company or that was publicly traded was able to get out Sunday night when gold hit 21.52 or when silver hit $50, because those happen on Sunday nights. You really need to have that futures contract to go with it. They got 10-ounce contracts, 1,000-ounce contracts, and 2,500 pounds of copper. So the barrier to entry is very low.
Is that it, Bob?
Yeah, that's part of the reason that it's actually the reason I wanted to ask that question is for that reason. I say the same thing with crude oil companies. If you've got, drillers or, downstreams, whether you're talking about Exxon or Chevron, if you've got an opinion on the commodity, and let's say you can't buy futures, you buy an ETF that tracks the commodity because you don't have CEO risk. Maybe the CEO sleeps with an intern, regardless of
yeah.
I always say that. I refrained.
Yeah, I mean, there's all these other risk things that you can't assess.
Right, but
so if you have an opinion in the asset, get involved in the asset in whatever way you can.
It's so easy to be canceled these days too. Like you can have a great CEO, something happens, and they're out.
People will always say like it's a leverage play to buy the miners because if all their fixed costs stay the same, it's going to exponentially go as the commodity goes. But the opposite can happen too. And if you want to leverage the shit out of something and have that sort of high delta and high gamma, you just call us. We'll structure an option for you in the underlying.
Something on the miners too is that you have to look on the details of their hedging operations. Who's to say that when gold wasn't, or like for silver, for instance, maybe they forward sold all their production at $30, utilizing short call options, things like that. People always say that gold and silver are manipulated, more silver, but the reality is the largest shorts that are out there are the people that produce it. They're hedging their forward production, they're locking in their costs, and they're able to come up with a smoother profitability scale going along. So, these are just a lot of things. Like I said, you need to be, rather than just a finger surgeon knowing just gold and got a couple of things, you need to be a hand surgeon if you're going to invest in these miners because of the complexities of them.
And this is why you have to watch shows like this and this show and shows like it with guests like Phil, because the knuckleheads on CNBC, the minute they talk about a commodity, they go, so gold is up, so we're looking at the miners. Idiots. Anyway, go ahead.
No, that's it. I got nothing more. That's a mic drop to me.
Phil, thanks for joining us, bud. Much appreciated.
Yeah. Oh, by the way, love your Metals Minute, the videos you've been putting out. Love those.
Oh, cool. Thank you very much.
Those are great.
Yeah, that was something recently pretty new. It was just like we get these actions and stuff, you know, people are going to call tomorrow and go, what the heck happened on there? And it was a good way to broadcast it in just like a minute or two. It's tough every day coming up with something, you know, sometimes the markets don't move, but it plugged a hole in our business as far as, you know, casting out a wide net to everybody, just kind of letting us know what our feelings are, you know, on these, on what's going on.
Well, thank you. Thank you guys all for joining us out there. We really do appreciate every one of you. Thank you very much.